Has a surprise fall in UK unemployment killed a September rate cut? Welcome to Market Insight, I'm Thomas Warner. The UK's Office for National Statistics says that the jobless rate fell to a 6-month low in July, defying a forecast rise. The data appears to weaken the case for a Bank of England rate cut in September. But with British workers' pay growing at its slowest pace in nearly 2 years during July, the overall picture looks far from clear. With me to provide some clarity is James Smith, developed Markets Economist at ING. James, a very warm welcome to you. You've written a piece today laying out your thoughts, and you actually described today's unemployment data as weird. What's so weird about it?
It is a bit weird, to be honest, because we've seen that drop in the jobless rate. Most people, myself included, expected that to notch a little bit higher in the data today. So it was a bit of a surprise. And actually, the unemployment rate in the UK is already kind of smoothed out. It's a moving average. It doesn't tend to jump around too much. It doesn't tend to surprise like this. So it's a bit surprising. I think what this tells us above all is that the data is still proving to be quite unreliable. The Bank of England has talked about this. It's very inconvenient because obviously the Bank of England is trying to make very difficult decisions at the moment, which in large part really hinge on what's happening in the jobs market. But I think it's a global story. Stats agencies are finding it harder and harder to get people to fill in their surveys, and that's creating all kinds of problems. So I think, in all honesty, the Bank of England will take this with a bit of a pinch of salt.
Well, given all the difficulty with the numbers that you've identified there, James, what is your sense of where we are in that battle against inflation?
Well, I think the battle is being won, but I think it's quite slow. I mean, if you look at the wage growth numbers, they've been coming down pretty gradually on an annual basis. They came down again in today's numbers, but they're still too high. You know, the private sector regular pay growth is up in the sort of 5% area. The Bank of England really needs that to come down to sort of the 3 to 4% area to be really comfortable, for that to be consistent with sort of longer term averages. So that's still a bit too high. Bank of England hawks would say what's going on is, you know, UK workers have more power than maybe they did over the last 10 years or so to sort of play catch up with those sort of hits to disposable income that they lost over the last couple of years, try and regain some of that. So that's the worry of the hawks. I think we should see further progress over the next few months, but I think for now it's enough to keep the Bank of England on a slow-moving path. They cut rates in August. I think they'll probably pause in September before cutting rates again in November.
And what's your outlook for the slightly longer term? I think you say in your piece that it's 3.25% by this time next year. How confident are you in that prediction?
Well, it's still quite hard. I mean, rate cuts have only just started. I think we're all trying to gauge how far and how fast the rate cuts need to come through. I think the news on wage growth, though it's been quite gradual, I think it will get better. I think the news more generally, when you look at surveys of how businesses are setting out their pricing plans, they're raising prices less aggressively. So I think the Bank of England has plenty of scope to get rates lower. I think most people would say what you might term a neutral rate is in the sort of 3 to 3.5% area. Personally, I think we'll get there by next summer. The risk is it takes longer, but I think for now that's a reasonable bet.
Let's just refocus on those numbers now. And lurking in that data was an inactivity rate edging up to 22.2%. That's a 8-year high, or very close to it. How significant a factor do you think that is for the UK economy, James?
Yeah, this is a really unusual one because the UK kind of stands out for the inactivity rate having gone up since the start of COVID. Most places might have seen a bit of a jump at the start of the pandemic, but in general, the trend on economic inactivity, the people that aren't employed but aren't seeking a job either, generally that's been going down as a share of the total workforce in most economies. So the UK is a bit of an outlier here. I mean, when you dig into the reasons, the overwhelming one is long-term sickness. I think, again, there's a bit of a skepticism perhaps about how accurate this data is. But I think the story, it tallies with other things we know. We know there's difficulties in the health service. So let's see. I think it is a big problem. It is one of the reasons why it's taking longer to get wage growth down to more comfortable levels for the Bank of England.
Just finally, James, we have heard a lot about the potential beneficial effect on productivity from AI. We know that productivity is one of the big challenges for the UK. Do you personally have any hope that AI is going to be a magic bullet for us?
Well, I think like everybody else, we're just waiting to see, right? I mean, clearly it's moving really quickly. I think in the short run, I think most people are saying that it's going to be sort of an aid for most people's jobs. It helps you do your job in a more productive way rather than sort of, creating widespread replacements for workers. I still think we need to see what happens with it, really. I think there's a lot to be worked through before this is really clear what it means for the labour market and the economy.
James Smith, Developed Markets Economist at ING. Thank you very much indeed for your thoughts today. And that is Market Insight. Don't forget you can watch more videos on Reuters.com.